Welcome back to Real Estate Mindset and good morning to you guys. Happy Friday. This video is going to be absolutely bonkers. I wanted to start about 30 seconds early so I can do my proper good mornings to Mary. Good morning. Thank you for joining us. Earl as well. Dean, my man Sheldon, appreciate you, brother. Vicky, Christy, good morning to you. Les, the Matty Young, I got your question. I will be answering it in this live Florida Beach Bum. I wish I was more like you. Good morning, Steve-O. Out in the West Coast, first place, appreciate you. There's our man, House Hacker, the investor extraordinaire, making money in San Diego. How do you make money in San Diego? Let's ask House Hacker. Good morning, House Hacker. Thank you for joining us. Ricardo, nice to see you as well, sir. Liam, nice to see you always. Good morning. There's my man, Johnny. Love you, Johnny. You keep me going. Liam, I see you again. I am blessed and so are you. There's my man, Sacred. I really just appreciate all you. MFH, I didn't get your email. MFH, email me. We're going to get started right now, you guys. Really happy to be here with you guys. There's Broadway. Good morning. There's I'm a Day. Everyone, Bronx. Appreciate all of you guys so much. You guys keep me going. Without you guys, I'm not doing this. I'm going to be honest. Without you, I'm not doing this. One of the really cool things about what I do, you guys, is my job is to empower people. And the second that I see that I'm not helping people and empowering people, I got to do something else. So keep your comments coming. Tell me your success stories. And we're going to get started today. I got a huge lineup for you guys. We're going to go into Evergrande. We're going to go into the housing market update. We're going to listen to a few videos on the Federal Reserve, the minutes, inflation, what they're going to do with interest rates. You guys, I haven't done a live in 2 days. And the 2 days that I haven't done a live in, so much has happened. It's absolutely crazy. And obviously we'll look at the 10-year as well. But I wanted to start by, let me just kind of rewind the clock, if I may, and kind of refresh you guys' mind, or if you're maybe new to my channel, let me explain my journey as a content creator. This will be very fast, but you guys, here's the thing with me as a content creator. My journey as a content creator happened abruptly. Essentially, I really didn't have any comprehension of video influence. I made a tremendous amount of mistakes. And in fact, you guys, I'm still making mistakes as a brand new content creator. And I just wanted to say, I wanted to thank you guys for holding me accountable, to help mold me into basically, you guys are keeping me grounded and you're keeping me focused on what matters in my life, which is empowering other people. Now, the thing is, guys, now, obviously, I lost everything. I lost everything in 2009. It cost me literally everything and much more than I could really put into words. You guys, I'm not that smart of a person, but I have learned an overwhelming amount of things through pain and through failure, and the type of pain and the type of failure that I hope that everyone will avoid. And that's part of the lessons that I want to give to you guys. Now, when I started my channel, one of the first things that I did is I got to the rooftops and I shouted down at people to hold. I shouted down at people, stop and think, get out of the fear of missing out, start using fundamentals to purchase real estate. Now, here's the thing, you guys. Now that we have pretty much successfully warned people, we need to move on to the other part of our channel, of this channel. We all need to evolve together. And essentially what I'm trying to say, guys, is I'm going to be adding from this point forward, and I have some really exciting announcements. I'm going to be restructuring my channel, but we're going to be talking moving forward a lot more about preparation. Okay, because you have to understand what I'm saying is basically the more that we're prepared, the more that we will win. And that's exactly what luck is. Luck is opportunity plus preparation. Understand that opportunity does not matter without preparation. And that's really what I'm trying to say, guys. So I have some really exciting stuff. And I also want to point out, you guys, now I understand it's very confusing in the market and I don't know everything that's going on. I'm doing the best I can. But what we do know for sure is opportunities can happen in a snap of a fingers. Okay. Opportunities can come up tomorrow. And those of us who have been preparing for the last year and a half or the last year, 2 years or whatever, we're going to have the best likelihood to succeed on the other end of this recession, on the end of this economic uncertainty. So I really hope you guys know that. And really, a case in point I wanted to show you guys is I'm going to start, and I'll get into China here. I want to show you guys just how many banks failed in 2009, 2010, and 2011. Now, the reason why I want to start with 2009 is understand that that's when the real problems started happening in the economy. Although hindsight's 2020, but when we look at 2007 and we look at 2008, the headwinds and the uncertainty was everywhere, right? Yet people still, like today, remained oblivious to the possibility of risk. So snap of the fingers, and let me show you guys essentially the banking failures of 2009. So you guys can see right here, this is just a quick list. I wanted to go through this very, very quickly. I'm going to put our first timestamp here. So you guys, in 2009, basically overnight, and this is why I couldn't make any money back in the day. So when I lost my job, essentially what I mean is like we lost mortgage. Back in 2009, the mortgage industry was dead, dead, dead. So, and we can see that here. So if you look at 2009, 140 lenders, okay, and predominantly mortgage lenders, obviously WAMU and Lehman went out of business, but 140 lenders, mortgage lenders went out of business in 2009. Snap of the fingers, you guys. But I also want to point out that the opportunity to purchase real estate lasted for years after that. So there's not really a rush right now, right? But that's not to give us an excuse to procrastinate and not to prepare, because if we don't prepare, someone else is. Understand, someone else is preparing to buy your house. Whoever has the best preparation is going to win. So have that type of concept. And look at guys, in 2010, it got even worse. 157 lenders, 157 went out of business in 2010. You guys, when I was a loan officer, I remember back in the day, I used to have to drop off paperwork when I funded and closed a loan. And I remember that, and this was in Southern California, Orange County. So in Orange County, Southern California, there were lenders on every street. Literally, there was like, on one intersection, there'd be 4 different lenders. And I remember one time when I was delivering closing documents to a lender, because I was with a broker. Brokers had better deals, lower interest rates back then. I remember one day that I was driving to New Century. You guys remember New Century? But I was driving there, and I remember on the way there, I must have seen 8 lenders going out of business. So in other words, you guys, these lenders weren't prepared. They didn't have the preparation, therefore they couldn't take advantage of the luck. Do y'all see what I'm saying? But things can happen in a split second. And look, you guys, it carried on into 2011 at 92 bank failures and 2012 at 51. So what I'm really essentially saying is yes, we want to stay preparing ourselves. We want to understand wedge. We want to understand cash flow. We want to understand how our local housing market works, because if we don't, then none of this matters. Do y'all understand what I'm saying? None of this matters unless you guys are becoming stronger by listening to my content. If you guys aren't becoming stronger by listening to my content, what I'm doing is not working. So again, I'm really excited. You guys, I have some really, really exciting announcements I'm going to give to you guys here in the coming days, and really kind of just dig in onto giving you guys overwhelming value. But let's start here with the China story. You guys, this is absolutely crazy right now. Now, China's property giant Evergrande files for bankruptcy protection in Manhattan court. Now, obviously, the housing market in China right now is absolutely being melted down. And I actually just watched Jack's live video. I don't know if you guys watched Jack's live video. He has the same article. I was like, oh my God, I'm using the same one. Really good guy. I suggest you guys check out his channel. I love that guy. Very, very cool. So just a little bit, guys, I'm going to read a little bit of this. This is a huge deal because, unlike 2008, the world could bail us out. The world bailed out in a little bit, right? In ways, the world bailed out the U.S. in 2008, 2009, 2010. But right now, what's so different as compared to 2008 is the entire world is suffering. And look at China. China's housing market, it's melting down like crazy, you guys. I'm going to read a little bit of this. China's heavily indebted property giant Evergrande Group on Thursday filed Chapter 15 bankruptcy protection in the U.S. court. I didn't know what a Chapter 15 is. Basically, you guys, a Chapter 15 is like a corporate bankruptcy, but it handles foreign people. So like over borders, right? Like in another country. In a filing with the Manhattan Bankruptcy Court, the company referenced restructuring proceedings in Hong Kong, the Cayman Islands, and the British Virgin Islands. In a separate statement, Evergrande on Friday said that it will ask the U.S. court for recognition of the schemes of arrangement under the offshore debt restructuring for Hong Kong and British Virgin Islands. It added the application is a normal procedure for the offshore debt restructuring and does not involve bankruptcy petition. So they're still going to burn people in the U.S., you guys. The U.S. is going to probably, if you're owed money, an investor, in the U.S., you ain't getting nothing from Evergrande. But that's not what this says, but we could pretty much assume that's going to happen. Now, this is crazy, you guys. This is the world's most indebted property developer. Now, they defaulted in 2021. So what's with the news? Why does this matter? Because that default in 2021 is really starting to show the harm it's creating for China and for the rest of the world as well, and announced an offshore debt restructuring program this March. So they've been restructuring since March. Now, trading of Evergrande shares has been suspended since March of 2022. So again, you guys, in China right now, the housing market is absolutely melting down. It is possible that that spreads. Obviously, it's going to spread, actually. It's not possible. It is going to spread. The contagion will spread. We know things, the market, the economy, and there's a lot that is based on emotion, especially with consumers. Now, let's explain Chapter 15. Chapter 15 bankruptcy protection allows a U.S. bankruptcy court to intervene in cross-border insolvency cases involving foreign companies that are undergoing restructuring from creditors. It aims to protect the debtors' assets and facilitate the recuse of business that are in financial trouble. So really, it's just giving them protection, you guys. This is really, really interesting because there's been so much going on with China, you guys, and so much going on with one of the biggest developers in the world. And really, what's really interesting to me is basically, let me go into a little bit of this. Okay, so here's another article right here, and I'm just going to get into the meat and potatoes here. Now, as of the end of the year, Evergrande reported liabilities totaling, think about this, okay, 335 billion. All right. The bank bailout in March that really kind of kicked the can down the road and restarted the time, space-time continuum as far as the recession, right? That was about 400 billion. This individual, one company, has just debt of 335 billion. Wrap your mind around that for 1 second, you guys, and look at this. This is one of the reasons why they went out of business. Look at this, y'all. I feel so bad for Chinese residences because everyone's getting a bad deal on this one. I don't know who's going to make any money on this, but Evergrande has pre-sold, listen to me, 720,000 apartments. Pre-sold 720,000 apartments, which means someone bought those apartments and they're not even completed yet. You guys, they wasted so much money. It is absolutely shocking because they were selling stuff before it was even built. There, and I haven't been in China. I want to go to China, but there apparently is entire blocks and entire areas where there are massive buildings that are gutted inside. It's just basically the outside. So I don't know if it's a flex move in China wanting to appear that they're doing well, but it's really kind of biting them, it's biting them in the butt, obviously, you guys. So that's not good at all. But the question, but really what I want to hone in on is the fact that, the world can't bail out the U.S., okay? But the U.S. is doing okay compared to China right now, unlike 2008. But there is going to be no one that bails us out. The only way that we're going to be bailed out, in my opinion, is money printing. And the money printing is destroying us. And hear me out on this. If it wasn't for all the money printing and low interest rates, we probably wouldn't even be in this situation. So these zero interest rate policies, these money printing policies, it's messing us up. And that's the only way I could really see this going on for much longer. But let's ask ourselves, you guys, what happened in Evergrande? Now, here's the thing. The U.S., in my opinion, overall is in a better position. So I don't think that there's going to be necessarily developers that, that this magnitude that will be going out of business necessarily. And one of the reasons is because in the US, you guys, and this is huge, we have fixed rates. In China, in Canada, and other places like that, people can't get fixed rates. So homeowners are at the mercy of inflation and interest rates. In the US, we can have fixed rates. There, they can't have fixed rates. And then also in the US is generally, we purchase after the home is completed. Even with new home builds, we could put an offer in, but we don't have to pay for the entire home. We can put an earnest money deposit for as little as $500. And the developer and the builder, they pretty much take all the risk. Whereas this situation with Evergrande is completely different, you guys. Now, again, just to recap, they're in $335 billion in liabilities. But, the March restructure. So this shouldn't be a surprise, to really anyone. I'm kind of surprised this is making big waves because again, this has been happening for quite some time. Let me show you guys what's happening now in the market. Let me start by showing you guys what's happening with VIX. Okay, so we're going to get started here now with the housing market update, you guys. Here's VIX. This is a volatility index. This has been skyrocketing. Sheldon asked me a little bit earlier. He's like, "Did you buy VIX?" I was like, man, it's up 30%. You guys, this is up about 30% since I said I was going to buy it. That's huge. But I did not buy it because I had a heart to heart with myself. And I was like, Trav, stay out of it. Just stay out of stocks. Keep doing what you're doing. Be proud of yourself. Make your money on your T-bills. So I'm risk off. I did not buy anything. I want to stay in my lane, but I thought you guys would find it interesting. Things aren't going well right now. And you guys, this has all been happening. Well, first of all, we've been calling it on the channel for about a year, a little less than a year and a half. But over the last 3 weeks, the whole market has been melting down in the last 3 weeks. Let's look at the 30-year, you guys. The 30-year has been on a little bit of a roller coaster ride. You can see that here. I'm sorry, not the 30-year, the 10-year Treasury. So the 10-year Treasury is down about 4 basis points. This 10-year Treasury tracks mortgage rates. Here's what's interesting. Okay, I see you, RNT. Give me an email. Shoot me an email, RNT, as well. But look at what's been going on this morning with the 10-year. So the 10-year started down. Okay, so it was started down about 4 to 5 basis points. And look at this. It skyrocketed up right here, right before market open. Okay, you guys see that? And then the market opens and then it plummets downward again. I mean, it's just been crazy. There's a lot of stuff. Oh, I see you, Ima. I got to start looking at the comments. You guys are throwing me off. I love you because I want to talk to you guys, but it throws me off when I'm doing this. But anyways, you guys, it's down 4 basis points. Let me show you the effect that's been having on mortgage rates. I mean, we are sitting at, look at the mortgage rates for great credit people, 25, I think it's 25% down or 20% down, 760 credit score. Your interest rate right now in a conventional mortgage, 7.37. Look at that, 7.37. This is good news, you guys. And people are like, Travis, why do you want rates to be high? Why do you guys want the housing market to crash? So that it's balanced, so that it gets healthy. It has to break a little bit before it can be healed. I don't want people to get hurt. That's why I have this channel. I don't want people to get hurt at all. But the reality is they are going to get hurt. The recent buyers especially are going to get hurt. Now, post 2022, those golden handcuffs homeowners, they're sitting pretty. But y'all, we needed rates to stay at this range this range in the 7%, probably even near the 8% for the start of the year. And we didn't see that. Instead, what happened is literally right before spring home buying season, we had the bank runs. Okay, so those bank runs led to the bailout, and also the interest rates dropped, and that, in my opinion, you guys, that really, really accelerated the equity growth this year, and the market was able to rebound at the start of this year. We're already seeing that fade away quite rapidly. Also, I want to point out what's interesting is Redfin, and I talked to Johnny. Johnny and I was like, oh, Redfin's updated, right? Me and Johnny, I was like, when is the data going to update? We want the data. So Redfin hasn't updated yet. And sometimes if you guys want a little bit of a cheat code, Redfin will actually sometimes update their data on Wednesdays, but their data center. And then they usually come out with their housing market article on Thursday, but it's Friday and they still haven't had it. So I don't know. Johnny's like, I think they're cooking the books, Travis, on the data. But you guys, here's the thing. When consumers really understand what's happening here, there's going to be nothing left to prop up, in my opinion, there's going to be nothing left to prop up the market. I understand the limited inventory. So we'll keep an eye on inventory as we move forward. And again, we're going to jump in now, you guys, to our first video. Okay, our first video is going to be basically about more rate hikes. So they're saying, and we're going to go into the CME FedWatch tool, and I'm going to show you how much, and literally in 3 days, how much the FedWatch tool has changed. The market is like, they don't know what's going to happen next year. There's actually rate cuts and increases, not really priced in, but starting to be priced in on the CME FedWatch tool. The market is like, what's the Fed going to do next? And the Fed's like, we've been telling you what we're going to do next for the last year and a half. What do you mean what we're going to do next? Just listen to us, right? That's what the Fed's doing. That's why my shirt usually says, don't fight the Fed, right? And then you know what? When we look at hindsight's 2020 and the housing market and say the stock market, everything comes crashing down, are we really going to be like surprised about that? Honestly, you know what I'm going to be surprised about? If there's a soft landing. I would be surprised about that because I have no idea how wages can really, catch up to the massive inflation. But anyways, guys, we're going to watch our first video right now on all of this stuff. I hope you guys enjoy it. If you can, tell me that the audio is okay.
According to minutes from the last month's Federal Reserve meeting, Fed officials still see upside risks to inflation. They said more rate hikes could be necessary to tame rising prices. Roger Ferguson joins us now, former Fed vice chair and a CNBC contributor. Roger, that was the headline. That was the takeaway. But I couldn't help. I was reminded of the late great Prince. The doves. There were a couple doves that were crying a little bit, and I heard that too. And I'm wondering. I think it's good. because nobody knows everything, and it's good that it's not everybody is there just to nod and in agreement. What do you think the doves see that maybe the rest of the FOMC that they don't see? What do you think they were looking at?
Well, first, I think you're right to point out that while the headline was pretty hawkish, there were a range of views that came through. I think what the contrarian point of view is that there's been quite a bit of tightening already in the system. There's still some uncertainty about credit tightening coming forward, and maybe it's time just to take a pause to let all of this work its way out. And there are a couple of places where that kind of sentiment came in around the risks being maybe a little bit more balanced and not all on the inflation side. So I think that's what the doves are seeing.
The 10-year might do some of the work for the Fed at this point. That could cause, I don't know, the housing market, mortgage rates, a lot of things are pegged to that. So maybe they don't need to take short rates higher. And the 2-year seems to be indicating that maybe there aren't too many near-term hikes in the cards. We're back to where we were. And all along, we've been saying maybe for 6 months, maybe, Roger, 1 or 2 more. And we're still, maybe 1 more. We're still stuck on that.
Well, we're stuck on it because, as the minutes themselves say, while inflation has come down, it's still very much above the 2% target. And the Fed said in the minutes that they want to be, I think they use the word, confident that inflation is, as they say, clearly on the path towards 2%. So the reason that we're continuing to get these hikes is inflation is still high. And as we've seen recently, there continues to be, in a positive sense, forward momentum in the economy, but that feeds through to imbalances that they're worried about. And so I think, yet again, we're in maybe a pause in September and 1 more after that, depending very much on what the data point out.
Roger, we nobody ever can see that far into the future. And the thing that scares me, I guess, is that maybe we're under, maybe we really, I've always been thinking that inflation would take care of itself after the supply chain issues went away. And I guess Robert Kaplan got me thinking about how much more money we do really have to spend with all these programs. And because now the narrative is there's not going to be a recession, or at least it's going to be a soft landing, what scares me is on the downside is we could have to go much higher, like back to like the rates that I was used to my entire life, whether it's 6, 7, 8%. Those weren't, they didn't cut off the economy or the stock market back then. We did just fine with 7.5% and 8% notes. Roger, would you see that as a possibility that the Fed just has to keep going and going and going for the fever to break?
I wouldn't say going and going and going. I would say 2 things, though. First, the experience of the last decade or more, 2 decades almost, of very, very low interest rates was certainly, as you point out, an anomaly. It was not normal for money to be free. Secondly, we do continue to see, as they point out, these imbalances in the labor market. So I think that's one of the things that is going to drive them to be open to going further. So I think the way I would think about this, Joe, is certainly 1 more, and the possibility, depending on how the data come in, of more than that. And the market, I think, has got to get its head around that concept. Mm-hmm. The reason I think the market was surprised is an expectation that the Fed is almost done. And the Fed itself keeps saying, look, it's not just that inflation has come down, it's the level that's still too high, and the need to be confident that it's clearly on a trajectory of 2%. So that to me says the possibility, as you suggest, of more work to be done. Right. Going, don't know. But I think it's just too early for the market to say, well, the Fed is done, or even too early to say 1 and done. I think it's very data dependent, and there's a lot of forward momentum here.
Well, if you try to paint a picture of a stock market that underperforms on a secular level for 5 years, let's say, and there have been some smart guys delivering alpha last year, guys that think that we could be, guys and gals that think we could be below historical yields or rates of return on the stock market for a number of years, and not necessarily just keep making new highs like we're used to. That's the scenario that I could see that would cause would cause financial assets not to perform well for 5 years if we're just underestimating getting all the way back to those higher levels if we need to. I hope not, like you, but
He's losing
Otherwise, the
money.
Fed.
The guy on the left is losing money in the stock market. I mean, maybe I'm wrong, but that's the impression I got. He looks like he's losing money to me. All right, guys. So, tell me what you think about that video. I like the guy on the right. I think he's being very realistic. I'm trying to be more humble myself, you guys. I'm so sorry. I told you I'm learning the hard way, but, you know, he's making very valid points. We are suffering, but the interest rate hikes are not enough. And we've been calling that from the very beginning here. We need to raise rates higher, especially if we're going to get to the 2% goal that the Federal Reserve has. We're just not there yet. So I'm going to show you. And I mean, tell me what you guys think. Do you guys agree? Should we lower rates? Is the whole market going to crash in 1 month? It's time to lower rates. Should we just keep it where it's at right now because we're starting to see it finally take effect in the economy? It's slowing down. There's certain aspects of the economy melting down. Or should we continue to hike rates? Personally, I think we should continue to hike rates. I kind of want to rip the Band-Aid off. I know there's going to be problems. But again, one of the concerns with the Federal Reserve is if they do too much too quickly, the banking system, the credit tightening, if that gets out of control, it's going to be like a triple whammy of hell and devastation. And that was one of the really horrible things about 2009 collapse, you guys. The credit tightening, they for residential mortgage financing, they completely redid the industry. So they turned the switch off, right? So really, really interesting. Let me show you guys what's happening with the Steamy Fed Watch tool because the market has changed. The market did change somewhat. The market is nuts. Absolutely nuts. Now, this has gone up slightly. So there's only an 11%, 11.5% chance, or the market is saying 11.5% chance of a 25 basis point hike in September. So that's up from 10%. That hasn't changed. But take a look at November, y'all. November has changed. It's not at the highest it's been, but now there's a rate, an increase of 25 basis points being priced in at about a 34.5% likelihood. That's up from about middle 20%. The record, we almost hit about 40%, I believe. But you can see that the market is being forced to price these things in. And that's one of the reasons why you see the stock market going down. Look at December. So December, wait until I get to January. You guys are going to lose it. It's crazy. I totally lost the word I was going to use. But anyways, 29.4% chance, 25 basis point rate hike. And look at this, you guys, 2.5% chance of a total of 75 basis point rate hike. That's pretty interesting. But look at January, you guys. I'm sorry, that was 50 basis points. Look at January. So this is crazy to me personally. So this is what's really changed in January. So in January, there's a 50% likelihood that rates stay where they're at right now. Okay. Followed by almost an even money here that there's either going to be a decrease down to 500 to 525 or an increase to 550 to 575. It's split down the middle. That's interesting to me. So the market is starting to it looks like a little bit smarter here. Now look at when we go into March. I really hope we can make it to July. If we make it to July before they start cutting rates, I think everything is going to just really unhinge and kind of be bust and be forced to reset. But look at you guys in March, they're basically even money on rates staying the same at 525 to 550, 13% chance of that 25 basis point hike unless it's done already, followed by a 35% chance of a rate cut down to 500 to 525. Now, obviously, you guys, this will all change if there's any movement to the discount rate or the federal funds rate. Okay, so this is all rating based on things right now. So this will change. But look at May, same thing in May with a cut from where we're at right now. That's only 30%. That's only 30%. That's unbelievable. And look at right here, you guys, 29.8% in June. So they're only giving us a 29.8% chance in June to have interest rates lower than what they're at right now. Because right now we're right here. This is where we're at right here, 525 to 550, right? I'm sorry, guys. Let me go back here real quick. Yeah, so let me see. I think that's really about it. I went to July, and here's July. I mean, there's really nothing here. It's just all over the place. So as time goes on, you guys, we're going to see, this change. But let me show you one other thing I find very interesting. So on one hand, the market is saying, we don't know what the Fed's going to do, but we hope it's only one more rate hike, and we're not even going to price in the one more rate hike. So we're not going to listen to the Fed. The Fed said one more rate hike this year, but we're not going to listen to them. Okay. Here's the other thing that's absolutely crazy. The Fed, this chart is the Fed listening to the market. So the other one was like the market listening to the Fed. This is the Fed listening to the market. And right now what the market is saying is you do not have control over inflation. This is the 5-year break-even inflation rate. You guys, this has not been able to go down since July 19th. Since July 19th, and it was making a lot of progress, this has shot up, okay, and has not going down. And basically, this is saying that 5 years from now, the inflation is going to be 2.24%. Now, this is a good indicator for us. This is an additional indicator for us to really understand when the Federal Reserve is probably going to start cutting interest rates. Now, probably this is going to have to be to 2% or under 2%, like 198, 199, 195, something like that, for the Federal Reserve to go ahead and start reducing interest rates. So again, very interesting. On one hand, the market right here is saying, let me go back to September. Okay. So on one hand, the market's saying, oh my gosh, look, it just went down. Look at that. So just right now, it went down to 9.5. Look at it. When I showed you guys seconds ago, it was 11.5. Let me see if November changed. It did change a little bit. It looks like that went to 34. Anyways, that's interesting to me. See how crazy this is? You guys, this changes very, very quickly. But again, on one hand, this is saying the Fed is in control, inflation's in control, no more rate hikes. And then the other part of the market is saying the inflation's not under control. We need more rate hikes. That's not exactly what this is saying, but it's conflicting. Do y'all see that? It's conflicting information, which again, that's generally a red flag. It's generally a red flag, you guys. So let's go on to our second video. In our second video, these are crazy videos today, you guys. Our second video, I got a super chat. I'm going to throw that up here. Our second video is on the Fed, that the Fed's going to need to keep rising interest rates. So there is a lot of additional news that we're getting that we actually missed for the last 4.5 months because the market rebounded like crazy, insane. So now we're getting a lot of the information back. Let me throw up this super chat real quick. I really appreciate you, Jack. Just to filling a Fed cut next, not hike, September, October. It all goes very bad here and worldwide. The credit event is coming. So basically what Jack is, and Jack, thank you, brother, for supporting the channel. I appreciate it, brother. You don't have to do that. You could send me 1 penny. I'll be happy, man. But I appreciate you contributing, man. And I appreciate you helping me out. So basically this is what Jack is saying, okay? Jack is saying that things are a lot worse than a lot of people realize. And the Fed can I think this is what you're saying, Jack, that things are so bad right now that we just can't see it as normal people. We just can't see it, but things are so bad right now. The Fed can just go ahead and start cutting rates right now. I think that's what you're saying, Jack. Let me know. But I am so my mind is so blown from all of this manipulation, you guys. Since when did we become bad persons for being self-disciplined and making sacrifices to get ahead in life? One of the things is, guys, I could start selling real estate right now. I could tell people all right, it's time to buy. But let me go back and real quick, guys, and I'll get into this video. Let me go back into my own journey, okay? Again, let's go back to 2008 when I lost everything, including my heart. I lost my heart. I lost my soul as well. I lost all of the attributes. But when I lost everything in 2009, the mortgage industry was dead. They were doing the Dodd-Frank Wall Street Reform and Consumer Protection Act, and they froze the mortgage. So I had no income. So one of the first jobs, you guys, that I had to get during that last collapse, well, first of all, there was no jobs. So the one only job in mortgages back in the day, new job was a loan modification. So when I went to go work, for loan modification, and here's what I'm trying to tell you. When I went to work for loan modification, they were excited when I started working there because I was always had the ability to speak to people from my heart. So everyone's like, yeah, Travis, you could talk to anyone, right? So, and I could really talk to anyone because I can sympathize with people. I can empathize with people. I'm real. I don't have to lie. I can just be myself. And I absolutely love that. But the thing is, guys, is I was never successful in loan modification because I didn't believe in it. So I could talk to people, I can relate, but I could never sell something that I do not believe in. And that's why you don't see me selling real estate right now. And the reason I couldn't believe in loan modification is because I didn't know what was going to happen, right? Because that was when loan modification first started. And back in the day, we had to tell people, stop making your mortgage payment, get 90 days behind, and you might be qualified for a loan modification. But first, give us $5,000. Okay. I couldn't sell that. I didn't know what was going to happen. I didn't feel comfortable. And just right now, and I want to get into real estate. I love real estate, you guys, but I don't believe in it right now because I don't know what's going to happen next. Okay. And based on my own fundamentals and based on how I was raised, right? The core fiber of my being tells me, Travis, the more you're disciplined, the more you save, the harder you work, the further you're going to get in life. And I'm not going to let go of those principles, you guys. I'm sorry. I'm sorry for being so bearish, but I'm not going to let go of those principles. My mother taught me those principles, and that's the core of who I am. I'm going to be the guy that says self-sacrifice, make goals, plan, find wedge, right? Don't use your emotion, find cash flow. It is what it is. And that's really, and understand what I'm saying, you guys. I want to sell real estate so bad, but I don't believe in it. Anyways, let's watch the second video, you guys, right now. Sorry for that little bit of a ramble because it wasn't a little ramble. I was rambling for quite some time right there. So sorry about that. But here's our next video. I think you guys will enjoy. Please let me know that the audio is okay. And also understand this. Happy Friday, and I absolutely love you guys.
Courtney, the minutes from the Fed's most recent meeting show that the most of the participants in the meeting still saw significant upside risk to inflation that could require further tightening. So at least in that one statement there, a pretty hawkish outlook there from the Federal Reserve. But hold on before you make your immediate trades, because these minutes are a mishmash of different points of view. Some of the top line comments, some saw downside risk to the economy and upside risk to unemployment. So that kind of sort of works against that, but it's a smaller number than the most who were concerned about the upside risk. A number said risks were two-sided, and we learned for the first time in these minutes that a couple participants, apparently not voters, just people who were at the table there among the bank presidents, wanted to keep the rates unchanged. So they were not in favor of, they were not voters apparently, or if they were, they didn't vote. They didn't vote what they said their concern was, wanting to keep rates unchanged. Now, I'm going to give you some positive comments, and I'm going to offset those with negative or hawkish comments. On the positive, dovish side, some saw tentative signs inflation could be abating, including softening core goods prices. There were continuing signs of supply and demand in labor coming into better balance. Tighter financial conditions were expected to slow consumption, and a gradual slowing appeared to be in progress in the economy. That was back when they met in July. However, that has not been the case. So here are some of the negative hawkish comments that were there. They said real GDP had demonstrated resilience. That's been the case over the intermediate period here, and the economy showing considerable momentum. Again, that's been the case. This group saw payroll and wage growth as still high, and several said significant disinflation had to become apparent in core services ex-housing for the Fed to relax on the idea of raising rates in the future. There was a high degree of uncertainty over the effects of past hikes. And one other thing I want to leave you with is this notion here that says that below trend growth is needed to bring supply in line with demand. We have not, Tyler, as you know from our discussion just an hour ago, had at least forecasts here for below trend growth. So that group in the Fed not getting what they want in terms of below trend growth.
All right, Steve, thank you very much.
So you guys think the market's starting to wake up? You know, think about this. 3 weeks ago, no one was talking about this on mainstream media, right? How many times have we listened to videos during our lives where these guys are just so bullish? You guys remember literally 3 to 4 weeks ago, the economy is great, GDP, we're not going to have a recession, we're going to have a soft landing, the labor market's tight, right? Home values are just going to go up. No, none of us have none of us can tell the future, but we can definitely look at probabilities and adjust accordingly, right? But let's see, what do we want to do now? I'm going to show you guys now. Look at this. This is insane. Okay, here is the overnight reverse purchases. Okay, so this is the repo market. You guys, we're in a situation. So there's like a whole bunch of tale of two tales right now, right? So we have like a tale of two tales. Let me explain this real quick. We have like 3 tale of two cities. We have, starting with homeowners, we have 2 entirely separate homeowners. We have people that bought prior to 2022, and we have people that bought after 2022. The people that bought before 2022, that's called the golden handcuff effect. The people that bought after 2022 are just handcuffed, right? They're not golden, they're just handcuffed. Tale of 2 different cities or 2 different worlds. Also, we see the same thing in the housing market as far as prices. We see places like Austin, total meltdown still going on right now, barely even a burp up in prices. And then yet we see places like Miami, like, holy smokes, how is Miami still doing good? Who's paying these prices with that massive equity run up and the massive unaffordability? So we have a tale of two stories going on here. The same thing in the economy. On one hand, we have somehow GDP up, labor market appearing tight, unemployment down in the face of overwhelming quantitative tightening. I mean, the quantitative tightening is overwhelming, right? And yet all of this other data says that things are okay. You guys, this is my point. Okay, I could be completely wrong, but if I'm wrong, you guys should be better off. These other people are wrong. If the bulls are wrong, it's possible. There's a probability you lose a lot. I lost everything last time. Maybe you won't. But the thing is I just, why would we be purchasing normal consumers? I'm not talking about house hackers. Okay, house hackers are going to find a deal in almost every market. Okay, I'm talking about normal people. I'm a normal person. I'm not a house hacker. I know how to house hack. I know how to invest in real estate. But to be honest with you guys, investing in residential real estate is not important to me. Okay, I said it. It's not. I don't want to make profit off of taking people's houses. I would rather invest in an apartment building or a strip mall or something like that. But I don't want to add to this problem. There's a massive problem. I'm rambling again. I apologize. My point is, let's just, there's nothing wrong with, for some of us, okay, I don't want to trigger anyone, but there's nothing wrong with some of us sitting on the sidelines, but there's an if, and it's a really big if. We're empowering ourselves. I'm not saying stay on the sidelines, keep your head in the sand, keep playing video games, keep going out to eat, keep getting drunk on Saturdays. I'm not saying that. I'm saying if you're on the sidelines, consider yourself blessed and consider yourself like lucky to be in a position to where you can now prepare for the opportunity. Because remember, without proper preparation, the opportunity doesn't matter. And that's exactly what luck is. Luck is opportunity plus preparation. And I'm trying to say is there should be, and I'm hoping in some metro areas, there should be overwhelming opportunities. And that's what I'm saying. Okay. In essence, that's pretty much everything I'm saying. Let's look at the reverse repo market, you guys. Now, this is the 1-day treasury, if you will. This is where banks are dumping their money and they're only holding it here for 1 day. And I think the Fed is giving them 5.3% right now. And really, the Fed wants this money. They want this money and they're probably going to burn it, right? So they want the lenders to buy treasuries, maybe like a 6-month or 2-year treasury. And then the treasury is going to burn that money because they're doing quantitative tightening, whatever. But the really crazy thing here, and I want to explain the perfect storm of events right now, okay? So again, on one hand, the economy is falling apart. On the other hand, rates aren't too low. Rates aren't high enough to combat inflation. Do you hear me? Rates aren't high enough to fully combat inflation. Yet the economy is falling apart. This is an insane situation. And this is another thing. Now, I believe that what you guys are seeing right here is going to put additional pressure on those short-term yields going up. Okay. So I think that we have several catalysts right now that are going to cause mortgage rates to continue to go up. These lenders right here, this money right here will not invest in the longer term yields, 2-year, 5-year, 10-year, if they can get a 1-day risk-free at 5.3%. And obviously the 5.3% is annualized, so they only get 1 day of that annualization. But y'all see my point? There's still a lot of money in the economy. There is a lot of money in the economy. It's being burned. But again, look at the trajectory. So, the debt deal passed and then boom, look at all that money came out of there. And now it's been sideways since July. Do y'all notice that everything changed in July? Do y'all notice that? And do you remember on my channel, we covered like day one when median sales price went down, the rolling average. Obviously, we look at the rolling average because it's the most recent data. There is a lot going on right now, y'all. And none of us know what's going to happen, but I think it's worth being aware of these uncertainties, being aware of these things. And again, you guys, I don't want to be overwhelming with my opinions, but you have to understand one of the reasons why I have such an extreme opinion is because of the pain that I went through myself, right? And I was a father as well. And man, that was just such a dark time in my life, you guys. I'm glad I went through it because of the empathy and all the stuff that I learned, but I don't know that everyone can make it out of that. I mean, it messed me up real good. So anyways, we're going to listen to our last video right now. I hope you guys enjoy the video. Sorry for my little bit of rambling. I feel really good. I feel positive right now. I feel like I'm on my goals. I'm really excited to share with you guys like the next plans of my channel. You guys are going to get the value, okay? Because again, real estate mindset is about to go to stage 2, and stage 2 is preparation. Stage 1 was awareness. And that's why I was like, you guys, the house market is going to crash. I still may do house market crash videos, okay? But we're going to be talking about preparation, and we're going to be talking about how to be winners, because we are that much closer. All right. And obviously I'm trying to buy my own house. Oh, I can't wait to do some of my lives. I'm just so excited to show you guys what I have come up with. Anyways, here's our last video. I hope you guys enjoy it. Just some more smart people talking about what they're assuming the Fed's going to do.
Interested in talking to you today because you've been sort of beating the drum on the disinflation story and that the Fed should stop raising rates. Are you worried that we might see a new wave of inflation with all this strong data?
No, I'm not. Let me tell you why. This is a very interesting fact. I was just reviewing the data. Last year, we hired almost 5 million new workers on net farm payroll, and we got GDP growth of less than 1%. It was the worst productivity performance in over 70 years. This year, we are hiring at less than half the pace, and we have 2 to 3 times the level of GDP growth that we had last year. Why is that? One of the biggest bounce backs in productivity that I've ever seen, and that's saving Jay Powell. That's why we could have this tremendous GDP growth and yet still have the disinflationary trends that are in the economy. Now, it is true, oil stopped going down, commodities have stopped going down, but I don't see those as starting a new trend. I see the productivity as being a basic deflationary force that will keep that inflation in check.
I get it, but we still have a tight labor market, and that is pressuring wage growth higher. I mean, in the past, a 2% rise in the unemployment rate was required to bring down wage growth by the amount that is needed today.
But wage growth is, first of all, 2 parts of wage growth. One is productivity. If the worker is actually producing more, than he or she should be getting paid more. So if we have 2 to 3% bounce back in productivity, and we have at least that would actually justify wages being 2 to 3% higher. And also, we have a catch-up. So, even though the last year over year real wages have increased, since the pandemic in March of 2020, real wages have fallen behind. Especially, you take a look at the UAW. They were under 3-year contracts, 3% a year. Well, when you have 9% inflation, you're going to fall behind. They're asking for some payback for the lost real income. Yeah, that's going to hurt the profits, Ford and General Motors and several others. But nonetheless, I think in many ways they deserve some of that payback, and they deserve a growth in productivity. So I'm not as worried about the wage growth as Powell seems to be, because I don't think that actually means a new inflationary spiral.
Professor Siegel, in terms of how the stock market has been digesting all of this, it seems as if there was great comfort that we were headed for something approximating a soft landing in the economy. And very quickly that turned into, wait a second, maybe the economy is reaccelerating. Maybe it's a little bit too quick. Maybe rates have to go higher on the long end. And can stocks handle that? I mean, you could also just say that the stock market needed a pullback because of the run it had before this anyway. But how does this all play out? Because it seems like higher rates than the economy can handle means we all of a sudden might be looking into next year for saying, do we really have to choke off growth? Does the Fed have to do more, or will rates themselves tip us into a downturn?
Well, Mike, one of the basic things we teach in economics is that real interest rates are very linked to real GDP growth. So, you were talking about that earlier quite correctly. The acceleration of real GDP growth means higher real interest rates, and therefore higher nominal interest rates for any given rate of inflation. Why is that not tanking the stock market now? Because real increases in productivity and real growth increase profits. So therefore, we have that great battle between the numerator and the denominator of what gives us stock prices. Profits in the numerator look a lot better than they did 3 months ago, even though that denominator has gone up. So the bond market has not done well. The stock market is holding its own.
Huh.
And you think it can continue despite this wobble?
I think it could continue. Now, this is a big increase in real rates, justified, I think, by the increase in growth. I do think that, Chairman Powell and the Fed have to be very two-sided. If they see a slippage of that productivity growth and, any sort of increase in initial claims, and again, we got another good number for claims this morning, he has to think about not only holding, but do I have to decrease the rate? Don't forget, we are going into political season. I guess you could say we're in political season and have been for a long time. Pressure is going to be mounting not to get a bad employment print.
All right, guys, let me know what you think there. This is really good here. This comment right here, let me talk about this comment if I may. I was hoping someone would actually make a comment like this, because that's what what this man has said, what Robert is saying here. The rate of consolidation of wealth is about to get even faster and even bigger. That's why we can see that tale of two tails. Okay, like the fact that we can see such an extreme difference of home owners right now, and not only that, you guys, home buyers. So on average, if you're a millennial, right, or even younger, you're getting wrecked. You're getting absolutely wrecked right now. If you're like a boomer and you got money, you are a king right now, right? The older generation that has money saved and they already have equity, they're running circles around these millennials. So there is a tale of two stories here, and I'm going to tell you guys right now that wealth gap is just getting bigger and bigger and bigger. So it's even more important: credit, income, assets, purchasing power, goals, focus, right? Things like that. And I also want to say this: all of this uncertainty, and again, Evergrande going under, all of these types of things. Look at this, guys. This is in the face of ridiculously low unemployment. Our unemployment rate is only 3.5%. That's insane. Not only is it 3.5%, look at this. We're still inverted. Okay. I want to show you guys this. This is the 10-year and this is the 2-year inversion. Okay. Right here. And look at the trajectory. Okay. Do you see the trajectory going up like that? So usually right before we go into recession, this uninverts. But the last inflationary recession, 70s and 80s, this did not invert, and we entered recession. So I want to point out, we're probably going into recession, or it's possible that we're in recession right now. I mean, this is the depth of the uninversion. Again, this is not 100% indication that we're in recession right now, but the trajectory is interesting, right? Do y'all see that? And let me show you guys one more thing about unemployment. Okay, here's the unemployment once again. Let me move my picture because I really want you guys to understand how bad things can fall apart in a snap of a fingers. Okay, so let's just go to the 1960s. And then, okay, look at this. Oh my gosh, I didn't realize, this is just luck. Okay, 1969, unemployment was what it was now. Unemployment in 1969, right in the front of the recession, was 3.5%. You guys, unemployment is 3.5% right now. Oh my gosh, that's crazy. I didn't realize that. But anyways, so after it entered recession, okay, look at the unemployment skyrocketed upward. Do y'all see that? It went up to 6.1%. Okay, so it does. So I understand. Oh yeah, unemployment's low right now, even though it's only part-time, jobs, whatever, fine. Let's just imagine that the labor market is so tight and it's just so strong. Fine, we'll imagine that. Snap of the fingers, y'all. Snap of the fingers. And look at this one right here. Okay, this is the 1970s recession. Unemployment was 4.8. Okay, right before going into the recession. So 4.8, and then boom, recession hits. Bam, that unemployment goes all the way up to 9%. Same thing here in the 1980s. Boom, 5.9, skyrockets up. Look at this one. This one's bad. So unemployment was already bad here in 1981. And then we got into recession and it went up even more. But honestly, this was like a rolling recession, it was like 2 recessions and 1 right here. That's why you pretty much see the unemployment continue to go up and then obviously down. And look at the 1990s again. 5.2, recession hits, unemployment skyrockets. Same thing here. Let's see. So 2000, November 2000, unemployment was 3.9%. entered recession. It was a little recession, got up at peak. Let's see, right here at 6.2. And look at this one. This one was bad, you guys. So this was the last great financial collapse, and it was at 4.7. So last financial collapse, unemployment was at 4.7, and that spiked all the way to 10%. In other words, guys, things can change quite rapidly, especially when we consider that this is what I'm looking at right now is a huge economic warning sign of future pain to come. And in fact, it is possible. Normally, we can use this as a gauge to know when we're in recession, kind of. But right now, it's going to be hard to use this to say whether or not we're in recession because of the inflation battle. So I don't know if you guys have been watching that, kind of asking yourselves, when are the rates going to go down and things like that. But more than likely, the rates will be going down next year. You guys, hopefully by that time, we will have better prices. But I just wanted to end, this video on basically, you guys understand what luck is. It's opportunity plus preparation. The opportunity doesn't matter unless you're prepared. Some of the ways that we can get prepared, there's basically, in my opinion, there's 3 category of buyers for the primary resident. We're not talking about investors. So like normal buyers, there's 3 categories. There's the people that are buying right now. Okay, maybe you have to buy. Maybe it's a job relocation. Maybe something in the family has happened. You have to downsize or you have to upsize. But there's really a few things, in my opinion, that people should be doing right now if they're purchasing real estate. And remember, you guys, I went back to look at my purchase contracts. I made 2 offers in 2021, and I made 1 offer in 2022 in January before I started this channel. I don't know if I told you guys that. So, few things people should be looking for if they're buying right now. Number 1, affordability, right? Comfortable. You want to purchase a house right now comfortably. Number 2, having the proper expectations, meaning hold the house, right? Understand you're probably going to have to hold the house for 10 to 15 years. Number 3, obviously don't settle. Love the house. Number 4, if at all possible, please, and we'll be doing this moving forward on almost all of my lives, find a house with wedge and with cash flow. Wedge allows us to do wedge, meaning purchasing property for under market value, allows us to weather the storm much better. If prices do go down and you have wedge or equity in your property, there's still possibility you can refinance. There's still possibility you can sell. So wedge is very important, as is cash flow. Now, if you're forced on the sideline, so you want to buy a house, even right now, if you could buy a house, you would, right? So there's that buyer. But if you are on the sidelines right now because you're forced there, whether your credit is too low or whether your debt to income ratio is too high, the first thing that I want to say is you never, ever give up on yourself and you remain hopeful. And probably usually the best thing to do is control your debt. You got to get your debt under control, you guys. You have to get your credit cards, especially, under control. And if you're drowning with credit cards, this is what I have to say: stop using your credit cards to the level. Stop using your credit cards. And generally, you want to pay the lowest one first, and you never want to go over 30% of your credit line. And then likewise, understand how you spend money, save your money. As far as income, make sure you're working as much as possible because your income is purchasing power, right? Now, if you're on the sidelines because you want to be on the sidelines, well, I'm on the sidelines, but I don't want to be. I'm choosing to be. Just chill. Okay? Just chill. Just understand that if you're like me, we are doing everything right. I'm living by my principles. I have goals. My goals are shaping my approach. I'm remaining focused and determined, and I'm loving my life, but I'm also increasing my purchasing power. I'm hunting for a deal every single day. And that's what I would say for the people that are buying. You guys, let me go into some of these starred comments. I appreciate you guys, being with me for so long this morning. Just want to start with Meta Young. I have a quick question. This is a good one. I have a quick question. If I have $100,000 in the bank, would you use it for 20% down on a house and pay closing costs? Or Meta, or use it for use $35,000 to pay off debt and put 10% down on a house and closing? What do you guys think? You guys see any red flags here? Okay, so first of all, Meta Young, I got to tell you, man, I see an immediate red flag in your comment. Okay, you shouldn't have $37,000 in debt to begin with. So I can't give personalized financial advice, but if I was you and I was in your shoes, I'm not putting 20% down. There's no way I'm putting 20% down. And in fact, before I do anything, brother, I'm going to pay off my debt, because more than likely, if I pay my debt off, my credit score is going to go up. But don't close your credit cards. If you close your credit cards, your score will go down. But the first thing I'm doing before I even look at a house is I'm paying my $37,000 in debt. I'm waiting about 45 days so my credit report updates, and then I have a better credit score. And then also, what I'm going to do, Matty Young, is I may, because like usually my plan is to put 10% down and pay all the PMI up front so that it's easier to cash flow. But because of how uncertain things are right now, I may only put 5% down, and I may wait for interest rates to go back down, and then I'll refinance that at that time. Now, at the time that I refinance it to a 5.5 rate from a 7% rate. I'll put more money down at that point. So what I'm trying to say is my down payment is going to be through my refinance, not through my purchase. Do you understand? Anyways, I hope that made sense. We got something from House Hacker. Don't y'all wish the Crook Lennar or any dishonest builders ended up overbuilding like Evergrande and ended up screwing themselves? Just only the dishonest and low quality builders. So I think they already are, man. I think they already are. I think they are overbuilding, House Hacker. It's just we didn't see that. We saw them rebound that this year. And in fact, not only do they rebound, take a look at this next comment. Warren Buffett purchased $700 million in DR Horton. So the home builders for right now through this seasonality did well. Again, the bank ballots, guys. I mean, let's be honest here. But the thing is, living in Omaha, let me know, when did he purchase DR Horton? Didn't he purchase DR Horton in the second quarter? So I believe he purchased from April to July. And then I also want to know, does he even still hold the stocks? Did he just make his money and did he sell all the stocks? Because the way that this reads is he's buying stocks right now, right? At like 52-week highs. I don't think so, but I don't know that for sure. All right, the banks really just finally started really tightening over the last month and a half. That could be part of the issue. That's probably why the Fed said they see the crash happening by September. So it's important to understand, AJ, that the credit tightening is affecting different segments of the financial sector differently. For example, the credit tightening with used cars and credit tightening with commercial financing, it's way worse than residential mortgages. But I will say also that residential mortgages probably for the last 2 months to 2.5 months have tightened up as well. And I'm going to be specific here. That's from an automated underwriting standpoint. The actual change in guidelines and regulations has not happened in residential mortgage, but they are tightening it up, meaning that they're not letting as many people in a challenging situation qualify. But the other thing is, guys, here's the problem as well. These banks are going to go till they die. So even though the credit tightening is there, these banks are so desperate that they're coming up with creative financing to have market share. So yeah, on one hand, credit's tightening, but if you have a 20% down payment, there's going to be a whole bunch of other toxic loans that you can get. So I think, AJ, we're going to start seeing that credit tightening happen. Let's be honest, when the values of houses keep going down, they're going to tighten credit a lot because the banks will be losing money on the collateral and the assets, right? This is from OSO. OSO, it's nice to see you, brother. It's been a while. What's the difference between 80s, 20%, and 7% rates? So 20% to 7. So he's basically saying rate is causing, okay, so he's saying like why back in the day when interest rates were 20%, it doesn't appear that it had as big as effect as today's 7% interest rates. That's easy, brother. And that's the reason why I say price is always more important, unless interest rates are 50%, right? But price is more important. And OSO, I will say that because the price escalation and equity run-up far exceeded the 80s as far as property value. All right, you guys. And then this is, I didn't know OSO is an agent. He's not selling because he doesn't want to give people a falling knife. Oscar, I appreciate you emailing me, you guys. I've been a little bit off of my emails because I have a corporate job. It's so hard for me to keep up. But I have a lot of announcements coming up regarding my emails, regarding corresponding with me. So just sit tight, man. I'm really sorry that I haven't. Okay. Boom, 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 boom. And then there's just last comment, you guys. This is from Omaha. Isn't there always an opportunity in any market? So, I know he's a realtor. I know, he's real. I'm not saying him, but realtors are generally bullish. But I'm pulling this comment up because of this, you guys. This premise of there's opportunity in any market is basically true. Okay. However, it could also not be true. And I'm saying it could also not be true because there's a probability. We're not going to say possible. We're not going to say certainties. There's a probability that what's a great opportunity today is not a great opportunity in 2 years from now. And that's really a point I've been trying to make. Like, it may be a good opportunity today, 2 years from now, you may realize you wasted your money. However, the other side of the coin is yeah, usually there's opportunities in every single market, so long as what? Wedge and cash flow, those two things I've been trying to tell you guys, right? Wedge and cash flow. The thing is in this market, those opportunities are rare. Is it impossible to find an opportunity based on today's definition of opportunity? It's not impossible. It's just extremely hard. But if you're going to buy a huge transaction, a huge item like a house, it should be hard. So hunt is my point. And I'm hunting every single day, and I can't wait to give you guys more information. I mean, I'm so excited about what's happening right now. But anyways, guys, I really hope you guys enjoyed this live stream today. I hope you guys found value. Sit tight for some overwhelming value in preparation. You guys have a great Friday. Don't be going out to the bars. Don't be getting drunk, you guys. Stay home, make some microwave popcorn, turn on your Netflix, play a board game, and you're welcome for saving you $200. Other than that, guys, if you're out there investing in real estate, I wish you luck, and I hope you win.